that we know that accounting practice, and you've been doing this for a long time, but we'll probably want to just educate our listeners as well. So when we move into the preparation, like like what are the first steps you recommend for someone looking to sell their accounting practice?
Oh,
And
oh
also
God.
like I'm sorry, and like what should the potential buyers be prioritizing during their search? If you could also like mix both of them. Take your time, but go ahead, go ahead.
Sure. Um, it's tricky. I think I even fell into this trap of hearing the word succession planning or the term succession planning and thinking it was a thing you can buy. And what it really is a series of really hard to answer questions. And that's disappointing because I think everyone wants a simpler solution. But it's so bespoke to the situation. So succession planning is very important. I think most accountants really, really, really care about making sure that their employees and their clients are well
Yeah.
taken care of.
Do you want to earn CPE credit? Take this course of My CPE to earn free credit. Click the link in the description to get started.
Welcome everyone to our podcast where we dive into the mechanics behind major career and business decisions. Today, we are exploring the intricate world of buying and selling accounting practices. I'm your host, Saul, and with me is a very special guest, Sarah Sharp, a distinguished deal attorney with extensive experience in the financial services sector. Sarah, thank you for joining us today.
Thank you for having me, Saul. I like being called distinguished. That's nice.
Yes, absolutely. To our listeners, Sarah's background is impressive. I'll just take some time to talk about it. Spanning work with SKNS Law Group, founding member of the Deal Academy, and also co-hosting the Acquisitive podcast, among various other hats that she has. Today, she'll help us understand what goes on into buying and selling accounting practices, the challenges involved, and how to approach these transactions successfully. So, Sarah, to kick things off, could you describe some of the current trends you're seeing in the market for accounting practices? How do these impact both buyers and sellers?
Oh, sure. So, I mean, I've been doing this for a number of years, and every year there's a new thing that is really different.
Hmm.
Last year, the trend, so right now it's 2024. Last year in 2023, we were dealing with the downstream effects of rising interest rates. So
Hmm.
a lot of these deals are financed by essentially a government loan called an SBA 7A loan.
Right.
Um, those have really specific requirements.
Hmm.
They used to be very cheap, like everything, right? 5% or 6% when I started doing this, maybe even less. And now they have been, 9, 10%, sometimes 10.75. And so you can imagine that that radically changes the profile of how you buy a practice. Specifically, it's kind of a snake eating its own tail. The SBA won't approve a transaction if you don't have enough cash flow to pay the debt and have enough to
Yeah.
live on,
Hmm.
but debt is blown up disproportionately because of the interest rate. So there's a lot fewer transactions that can be, or companies that can be successfully financed through the SBA 7A loan. So that was last year. And then all of a sudden, White Knight shows up this year with in the form of private equity. So
Uh-huh.
now everyone's saying, good, I don't need your SBA 7A loan, which would never work for my practice anyways. I'm going to wait for private equity to come and scoop me up because that's been making the news a lot lately. So I'm seeing that downstream. People are raising the prices and hoping that a private equity buyer comes in and just buys them all cash. And that's not really the way it used to be. Typically, SBA 7A kind of made the market. So you would say, well, if somebody can't get a loan to buy this, then they're not going to come in with a bunch of cash. So realistically, I can only advertise that I want the asking price that I could actually get financed. But now you can advertise whatever you want because maybe private
Yeah.
equity will come in and buy you.
Yeah, absolutely. I mean, that's fascinating. And it's always fascinating, and I'm always curious to know, and probably also our listeners are curious to know that what makes the accounting practice market unique compared to other industries?
Oh, I mean, accountants is my view. I just think that the people are great. But what you're probably more interested in is why is it appealing? I
Yes.
think a lot of accountants are surprised to learn how many buyers are not in the space. I wish I had this book. It's back there on my shelf. There's another trend, which is Harvard Business Review's Guide to Buying a Small Business.
Hmm.
There's been a ton of people who refer to themselves as search funders or entrepreneurs through acquisition. So if you see
Hmm.
ETA, that's
Hmm.
what it's referring to. And they're looking for any company to buy. So they're looking at HVAC, coin laundry. This is real from a couple weeks ago. Golf cart dealership. They're looking at any company to buy
Yep.
through SBA 7A loan, which you can do sometimes with no money down. And then they want to run the company. And there's a bunch of influencers on social media right now who say, buy boring businesses, swipe up to subscribe for how you can be a billionaire by running an HVAC company in Texas. I live on a boat in the Mediterranean
Yeah.
and 67 coin laundries. So it can be very attractive to somebody who's looking for their next thing. And startups don't have the same venture capital coming after them like they used to in the like nascent Shark Tank days.
Yeah.
So I think it's a new, more verified way of doing that. But once people decide they want to do that and they dig in, they realize HVAC companies are insane to run. They
Hmm.
have 20 trucks, getting people to be where they're supposed to be on time when you know nothing about HVAC and you've never known anything about any home repair can be really
Correct.
challenging. So a lot of these search funders are, white collar professionals. And when they enter the space, they naturally gravitate towards accounting practices because it makes sense to them. There's a front office person, it reminds them of their family. And it just,
Correct.
the hours are 9 to 5 and things like that. And they typically cash flow. So it's very appealing. And I think it's a good target. It's a good acquisition
No, I
target.
agree to you. I agree to you. It's I now I get it. I mean, it's easier to understand. They know the business inside out. I think accounting is one of the oldest professions in the world. So, right. Okay.
Yeah. Yeah.
Anyway, yeah, but I mean, that's very interesting. So, we'll up the notch a little bit, So, now that we know that accounting practice, and you've been doing this for a long time, but we'll probably want to just educate our listeners as well. So when we move into the preparation, like, like what are the first steps you recommend for someone looking to sell their accounting practice?
Oh,
And
oh
also
God.
like I'm sorry, and like what should the potential buyers be prioritizing during their search? If you could also like mix both of them. Take your time, but go ahead, go ahead.
Sure. Um, it's tricky. I think I even fell into this trap of hearing the word succession planning or the term succession planning and thinking it was a thing you can buy. And what it really is a series of really hard to answer questions. And that's disappointing because I think everyone wants a simpler solution. But it's so bespoke to the situation. So succession planning is very important. I think most accountants really, really, really care about making sure that their employees and their clients are well taken
Yep.
care of. And
Hmm.
that preservation of their legacy is their number one interest. That's the
Yep.
one thing I hear over and over again. And it really distinguishes the type of buyer people are interested in. People, often have built a beautiful Main Street accounting practice where they've worked for, they've done the books for a company as it's grown, and they go, to the restaurant where they do the books for their
Yep.
anniversary every year. And, there's this inextricable tie.
Access latest and trending CPE courses with my CPE's Unlimited Access subscription. Subscribe now.
My dad owned a business growing up. He was a like small commercial and residential general contractor in East
Hmm.
Tennessee. And so, we would always go, oh, that's the restaurant my dad built. I remember, walking around the job site with him.
Yeah.
And for accountants, you have the same thing. You're on the inside of a bunch of different companies and you develop these relationships over the course of years and years and years. Super common for me to find tax professionals who are also still doing the taxes for big clients' adult children.
Yes.
It is just this inextricable familial thing. So if that's what's important to you, if taking care of your clients and making sure they're taken care of is what's important to you, then you have to figure out succession planning with enough lead time, with enough runway, because you'll run out of runway if you wait until you think, I can't do another tax season. I just can't do it. This is it for me. Then it's too late. You're going to have a
Yeah.
fire sale. You're not going to be able to make sure your clients are, maybe you'll get lucky, but for the most part, you won't have that warm handoff. There's probably a lot of kind of weird, unusual stuff, if you think about it, that you've been doing for clients for years that really needs some explaining too. So
Correct.
you want to have enough runway emotionally and mentally, health wise, and financially to be able to sell and stay somewhat involved for that transition so that you can actually get the benefit of it and have your clients taken care of. And not to continue talking, but it's a podcast, and I think that's what you're supposed to do. So the issue is that it's so seasonal. So, you have it's the most seasonal industry for M&A, because it, follows tax. Even if you're not a tax professional, just the whole industry itself is acting on the tax calendar. So, January through, let's start in the beginning of the year, January through April, nothing is happening.
Yep.
No one is buying or selling, with very rare exceptions of, because they started and they didn't finish when they meant to, or because
Yep.
the other deals I've closed during tax season were things like, the seller's really sick, or,
Yeah.
like really bad outcomes, or going to prison for, those are real things. So you
We are going to
don't,
talk about that. I definitely want, I'm going to come back to that, but carry on.
yeah, things you can't avoid. Otherwise, it's dead January, February, March, April, May. Everyone's on vacation and digging out from all of the things that we're building up during tax season. June, people look around and think, I meant to sell my practice. What do I do? Should I Google something? And maybe they get it together really fast
Hmm.
and they get listed with a broker or something, and they're getting offers in June, July, and maybe they take an offer, they're under the letter of intent, they're going through a little diligence phase, something falls apart
Hmm.
around August, 5,
Yep.
6 weeks in. And then they're looking at September 15th deadlines, October 15th deadlines, Thanksgiving,
Yep.
Christmas, January tax season. So it's this narrow little window where you really don't have time to waste courting a potential buyer, because you need to figure it out really fast if it's not going to be a good fit. So that's the seasonality component, makes it such that you need to work with enough runway that
Yep.
maybe you have 2 of those seasons. And come May, you are like prepared and ready to list your practice. So I think at least you should start the process in January and go through an entire tax season with it in your mind. If somebody else is doing this next year, what do they need to know? And
Yes.
start systematizing, creating notes, creating, all of the records you'll need, and making note of different transitional things as you're going
Yep.
through it.
Yep.
And then be ready. Have your broker picked out, or have established your team, talk to me, talk to whomever, and then get ready so that you're ready to go in May. And that will also get you the highest price, because a lot of buyers are sitting there January, February, they're not even doing tax, right? They're in a corporate job. They're looking to go out on their own. So they're just sitting there with nothing to do, going,
Yep.
there's nothing on the market. I don't understand why. It's so hard to find an accounting practice. I would love to quit my 9 to 5 job and run my own business, but I can't. There's nothing there. So if you can get it listed in May, I mean, you wouldn't believe it's like a feeding frenzy. So
Yeah.
that's
Well,
my.
but yeah, that's it. I think you brought up a very interesting point. One was the runway that you want to be well in advance, and second thing you talked about succession planning, but then you also talked about that emotional journey that this individual goes through because the person who is selling, that person is probably emotional towards his clients, towards his employees, and they're like, I built this 30 years, I gave in, whatever. But as for the buyer, it's an investment. So if they see an opportunity, they want to click on it as soon as possible. So that's always going to happen. But that emotional journey, I'm pretty certain you must have come across those scenarios as well, wherein it's the emotional journey which has led to that entire, I wouldn't say really a delay, but you take a time to let go. It's not like you just sold it today and like I got my check and I'm done. You'll probably like still be invested into the firm during the transition to make sure that everything is going according to plan, right? So
Scary. Yeah, it's that hard. I think what you're pointing out is a very tricky balance because you want to have the decision and the wherewithal to have enough gas in the tank to be able to list and sell and transition a practice. And maybe it takes 2 years. So you want to have that much, but also when you have that much energy left, most people don't think, I'm ready to hang it up. You don't know how you're going to feel 2 years from now. It's very scary. As I age, I understand more and more how it must be very, very scary to think this is it. I'm going to be signing a non-compete. I'm going to be selling what I've built and walking away. And, a lot of people maybe don't have a ton of hobbies outside of work, and it can be incredibly intimidating. And then a smart broker in this space kind of helped me understand as well. It's not a decision confined to the business owner, the seller. First of all, sometimes there's multiple owners. So you have a real
yeah.
whack-a-mole of this person's really interested in selling, this person doesn't want to, and how you can possibly make everybody get what they want. That can be really challenging. But succession planning is supposed to solve for that. But everybody's got a family. And so a lot of times the spouse is not ready for the person to retire. Maybe they're not ready to retire themselves, or maybe they're not ready to have the spouse home all day, or maybe they're more monetarily frugal and they're just very anxious about not having any more income. And so the
Yeah.
person you're talking to is ready all day long, but there's this weird resistance that you can't quite put your finger on. And it's that every time they go home, their spouse is saying, I don't know if we should do this. So it's a
Hmm.
whole ecosystem that has to line up.
That's very interesting. It sounds like, at the end of the day, thorough preparation is the key. That's what it is. Now let's, I may be asking too much for you, but if you could just outline, I'm noticing three aspects. One is the legal aspect, one is the financial aspect, and then one is the operational preparations. These are the three aspects that I'm looking at. So if you could outline the legal, financial, and operational preparations which are essential for this process. Take your
Oh, that's
time, list it down,
yeah.
and
I know I'm writing them down because I like that. Legal,
yeah,
operational, financial. Well,
yeah,
I could talk all day about the legal aspects because that's what I do. You generally will want to figure out what kind of entity you are and who owns you, which sounds like a very obvious thing, but it's not always very transparent. It's very common to realize that you bought out a partner in 1979 and you never documented it, for instance, right? So, figuring that stuff out on the front end is really important. A little bit of preparatory diligence, just to make sure Because you've got to anticipate that a buyer's going to come in and they're going to ask, and you can Google diligence checklist to see what they're going to ask for. They're going to ask for employment contracts, employment handbooks, for your operational documents, like what you filed with the Secretary of State or any operating agreement, shareholder agreement. And they're going to review all of those and ask questions. So if there's anything that needs buttoning up there, you want to do that as soon as possible. You want to be the one to do it. You don't want to wait for them to tell you to do it, because then they're more likely to, adjust the price or get spooked.
Correct.
So that's getting ready. I think getting a good lawyer, of course, I think is very important. There's that can make or break a deal. I think there's, in this space, usually we're talking in the smaller deals. So, most of what I'm dealing with is in the smaller sub $5 million deal. And then in those space, you really have three, I'll say four professionals that are part of building your team that are involved in these transactions. There's me, the lawyer, the only one I know of who
Naturally.
on this.
Yep.
There's the banker. So if there's an SBA loan, there's going to be a banker, and they're going to have a lot of involvement for the buyer side. And there's usually a broker. And those are the ones who list the deal, and they get by far and large the most money out of the deals. So so they're, usually but they're all created very differently. So, the banker, the broker, and then a lot of times people will hire a valuation expert. So like another CPA to come in and review the books, and then me. So you've got financial diligence, the bank, lawyer, and any one of those people, if they're not very familiar with the particular industry, can really scuttle a deal. So just flip it and it's not doable anymore. And I see it happen a lot just by giving bad advice. Certainly, if you get a bank, there's a disconnect between what the sales, like the business development officer, will say and underwriting at some banks. So you might get a promise that you proceed with, and then at the last second, the rug is pulled out from under you. And that can scuttle a deal. A lot of times, though, it's the lawyers. I'm embarrassed to say, because, there's things that are really specific to this type of transaction, very common. But if you only do $100 million deals, you're going to think it's crazy. And, I've been on deals that were, the purchase price was less than $1 million. And there was a large law firm staffed on the other side with 4 separate attorneys, with 4 separate associates underneath each of those attorneys, running all the things independently. And, the deal costs were through the roof. It was like 6 figures of their attorney's fees. And then the buyer has to pay me to attend each of those calls and argue with each of those lawyers. So that can ruin a deal for sure. So you want to kind of get your legal team in order and make sure that you're not getting too far afield. The financial differences are like what you need to do to prepare your practice for sale in the financial perspective is probably, like the biggest deal in accounting, right? You will find folks who will buy firms that have a downward trend line, but obviously a lot fewer. Everyone wants growth year over year for the last 3 years. And that's quite challenging. And if you have a down year, then you're in a situation where you think, do I wait another year so I can get that 3-year growth? And maybe you should. So, you're doing all of this while you're also preparing emotionally to retire, but you need to be investing in your business more than you ever have. That's a hard balance. To keep that trend line going upwards. And then, I think it's very good to take a look at your books logically. In 2021 and 2022, or 2020 and 2021, there were a lot of, for instance, one-time like non-recurring revenue items. A lot of folks in this industry were preparing CARES Act stuff for their clients. So they were doing PPP loan applications for their clients, and they were just billing those hourly. So you might have a trend line that went up for those 2 years, and looks like you're just going through the roof, but ethically, you really have an obligation to say to the buyer, you can't expect to make that much. That was non-recurring revenue. That was a one-time thing. Unless we have
Yep.
another pandemic with weird other government stimulus, I'm going to back that out of my income. So taking kind of a look at things like you were the buyer and the other stuff, right? If you've got maybe you're actually getting more benefit from your business than it looks like it because you own the office building and you're paying yourself like more rent than a stranger
Yeah.
would. So,
Yeah.
put that
Yeah.
back in the seller discretionary earnings. That really is more profit. That's really more owner take home. So it cuts both ways, but like taking a really good look at the financial health of your business like you're a neutral third party and making sure that it's honest and accurately descriptive of what a buyer could expect, I think is your preparation there.
Wow. Interesting. Well, there's, it's a funny story, but you mentioned there are four people, usually the four people that you talked about. I actually did speak to somebody last year who was thinking about quitting, but he had I don't know how I would call it. I don't know whether it would be a psychic or an astrologer or a clairvoyant or whoever you would call it, who was part of the deal. And she had like the thing to say at that. But I don't know whether you have faced that situation ever in your deals, but
I
that
have
has happened.
not. I love that. I want to hire a clairvoyant to bless the deals. That's extraordinary.
Yeah, it
I mean,
is.
there's a definite soft factor to a good match. My grandmother
Absolutely.
said there was a lid for every pot.
Yep.
And when you deal with hundreds of accounting practices nationwide, buying and selling, you start to see how something that, sometimes things are more broadly appealing, like it's a cloud-based firm and it's got incredible amounts of profit and the owner doesn't even work, they're
Yeah.
just on the golf course. Like those are going to be, of course, appealing to more folks, but there's some people want to relocate to the middle of nowhere and they're just desperate to do that, and
Yep.
they just find a way to get sunk into a new community where they've always wanted to live and have a good, well-respected job starting out. And so, your practice that you've built on this main street of this small town America could be like the absolute dream for some buyers.
Absolutely, absolutely. Now let's touch into your skill sets. Let's talk about the legal side.
Uh,
So, what I want to know is, what are some common legal obstacles in these transactions and how can they be effectively managed?
Well, so, you've got to, let me tell you about the different stages. You have the stage, the pre-contemplative stage, where you're still just thinking about maybe listing. From a legal perspective, I, of course, like to get involved as soon as possible with all the deals. Um, I operate in this space a lot, so I like to be able to, say, hey, here the good brokers, the good bankers, these are the ones that are gonna like really streamline your experience.
Mm-hmm.
And
Mm-hmm.
here are the big things to watch out for as early as possible. But for the most part, if you're a seller, I haven't really interacted with you until you're under LOI, letter of intent.
Mm-hmm.
So unless I also represented you when you bought, which happens
Yep.
sometimes. Every buyer is eventually a seller. So uh,
Yes, absolutely.
that's the thing. But so, you've listed, you've decided you want to sell, you've received letters of intent, and usually you've accepted one. And the letter of
Yep.
intent has all the terms in it. And what I
Right.
really wish is that I could weigh in before people agree to your letter of intent because it's all the terms in the transaction usually. And I
Correct.
understand people don't want to pay a lawyer before they know that they have a deal or a potential buyer on the table, but that's also the area that somebody like me can add the most value. So
Yep.
that's that was the genesis of creating Deal Academy, was like, okay, great. Let me put everything I know about letters of intent in a course, make it real affordable and, very low stakes. I think I understand why people have the feeling that when you engage an attorney, you're going to start getting these huge invoices that, you can't turn
Yes.
them off, right? So you have an engaged attorney, you just have bought a course to hopefully try to like get you well educated as to those deal terms so you can do it yourself. That's a big part. So when I get involved, I'm looking at the letter of intent, I'm looking at the terms, kind of saying, was anything left out or do we need to renegotiate anything? And then I'm making myself available for calls during the diligence process. The diligence
Yep.
process is buyers asking a bunch of questions, asking for a ton of documents. So they do that. And at some point, the buyer usually will get comfortable. They've met with the seller a couple of times. They've done a site visit. They've done enough diligence. They've maybe gotten their commitment letter from the bank. And then the buyer typically initiates the purchase agreements. So when I represent the buyer, I do the huge packet of transaction documents. When I represent the seller, I'm waiting for them, and then I'm tearing apart all of these documents. And the real big legal lift is the going back and forth with those contracts and getting them in a good place and getting them signed in anticipation of closing and negotiated. So
Well, I would definitely want to know your secret about how you're able to keep a track of which one is selling and which one is buying. But that's a different discussion. But I think, the legal side, you've given a very good insight on the legal side. And, we talked about the financials because at the end of the day, that's the crux of the deal, right? What are you
yeah.
buying or, I mean, what are you paying or what are you getting for selling or, the either way around. So valuation is, I think, the critical aspect here. So, and, you mentioned that, for an accounting practice, you should probably look at your books. I'm like, hey, isn't that understood that an accounting practice would have got their books valued, books right? But I guess from a valuation standpoint, I think it's a little bit different, right? So could you like walk us through like how an accounting practice is usually valued?
Yeah, I mean, there's a rule of thumb for a small accounting practice that they sell for between 0.9 and 1.09 x their gross revenue. So that's the multiple. Companies generally trade for a multiple of gross revenue, and that's just a way that the industry of potential buyers in the world of any business have of, just making it all apples to apples. So,
Yep.
what is the most standardizable gross revenue? You can say there's a multiple of seller discretionary earnings, and I'll hear that too. But that denominator, seller discretionary earnings, has a lot more manipulation to it than gross revenue. So if you just
Right.
take the
Yeah.
top line and you apply the multiple to that, that is generally speaking true. But I see them at 0.5 if they're for instance, I have no recurring clients. Like I have some that are just project based. And so, they're almost like a law firm,
Yeah.
where we just have people come in and leave, and those sell for way lower. And then you can see ones like the magical cloud accounting practice where everyone works remote. And they have all of the most up-to-date software and they have a huge profit margin. That is more broadly appealing. And you pull from all over the nation as far as potential buyers. So that's going to trade higher, probably like 1.3 even maybe right now. So, or if you're in private equity, 2.5, who knows? So that's the valuation. It is, I mean, some of these buyers are not accountants. So
Yeah.
they feel like they're at a educational disadvantage. And so they do want to hire a valuation expert to go through the books. But, that's the reason I really like this industry over others is the books are pretty clean. Like you're
Yeah.
starting off with a good space,
Yep.
um, which makes you able to hit the ground running more easily.
Correct.
But there's stuff that sneaks up. I mean, sometimes people want to buy a particular revenue stream.
Yep.
So they'll say, I want to leave all the attest work. I don't want any of that, but I want all the other stuff. And that can take a real professional to tease out, okay, well, what overhead goes with the stuff you're leaving behind? And
Yep.
also the stuff you're leaving behind, which clients have affiliated work that might be compromised by that. It takes a little bit more, than just the broad brush of looking at a P&L and knowing it's 100% accurate and will predict your future.
Well, I wouldn't really want like the real crux of the deal, but I gather that this is where when valuation has been done, I guess there is a lot of negotiation involved. Now, I don't really want you to tell me how a negotiation should happen, but like if you could give me a few tips or like negotiation strategies which you think would be most effective when it comes to it.
I have very strong opinions about that.
Okay.
Can imagine. I have developed strong opinions, and it's very unique to, like, I have experience in the mid-market and the $100 million firm space, and even just the $20 million firm space. There, and private equity and all of these type of mid-market players, the buying process, they have a team devoted to it, an acquisitions team, an M&A team, mergers and acquisitions team,
Yep.
and people who all they do is scout for deals, negotiate deals, and that's their whole job. And
Right.
so what has happened is all of the books about mergers and acquisitions are written based on what happens at that level. And all
Yep.
of Google results are based on what happens at this big level where all of these Harvard MBAs are sitting there and reading books and waxing philosophical and negotiating indemnification caps. But then we're
Yep.
trying to pull that down and apply it to a smaller deal where you have owners who are also operating the business, usually on both sides. So
Yep.
they are not interested in, like, an 8-hour discussion on indemnification limits or survival of reps and warranties limits, because they, like we've talked about, have an enormous lift because they're having to run the business, run the
Yep.
deal, and keep the business during the deal process going up in case that deal falls through. They have to not just run it as well as it has been, but continue to make it even better. And it's
Yep.
usually more towards the end of their career. So they're having to gin up all of this extra energy and effort to do all the operational stuff to, keep it flowing financially, not let the employees know, because what if they left? Oh my gosh. Not let the clients know. What if they left? Oh my gosh, but also run the deal. So it is in everyone's best interest in the small scale accounting practice buyout to not negotiate more than one, maybe 2 rounds, because people get furious. They get
Okay.
so overwhelmed if you start just going back and forth with little changes, or the stuff that lawyers care the most about, which is usually indemnification and limitation of liability, is
Correct.
hard to explain that to a regular business owner in a way that they are feeling good about paying you, hundreds of dollars an hour to talk about it.
Yes.
This is very academic, it's esoteric, it's not how much you're getting paid and when. It's like, what happens if, some adverse outcome that we're not even going to be able to describe happens 2 years from now. So I think very little negotiation should happen, because it will sour the deal, and everybody will wind up disliking each other just in time for closing when they're supposed to be doing this warm handoff.
Yep.
So that is why I think the letter of intent is so powerful. If you negotiate everything at the letter of intent phase, when people still have energy and when it's still in
Yep.
a very brief document, and
Yep.
where you haven't invested a lot, you can walk away. If you disagree,
Yep.
that's fine. I
No
understand.
harm done. Yeah.
Yeah, we'll just go on and get a different letter of intent. Like, that is the
Yep.
time to negotiate every deal point. In my view, in a perfect world, you go back and forth 3 or 4 times in the letter of intent until you really are on the same page. You sail through the rest of it. Otherwise, you're going to tank, and everybody's going to be so upset because they're razor thin margin of deal fatigue in these deals.
Well, like you said, like you got to negotiate it at a letter of intent level because that's the best way to do it in a perfect world. And that's exactly what, we're getting at.
Yeah.
Now, obviously, you're dealt with too many cases, and I'm pretty certain that, no deal just goes through as sweet as it looks like, you know. So could it be possible for you to share like a case study where a transaction faced significant challenges and how those were overcome?
Um, yeah, absolutely. Pretty much everything I've said, I've seen. So I've definitely seen the hypothetical I gave of the non-recurring revenue for the CARES Act
Yep.
preparations that happened in 2 years that made every firm that was doing that stuff look more profitable than it was. I saw almost simultaneously two different sellers treat that very differently. One
Hmm.
seller fully buried all of that information, described it hourly, didn't call it out, refused to have the ability to even extract what percentage of the hourly work they did might be non-recurring revenue, and got incredibly angry when questioned about it. The other
Hmm.
seller put it on their listing. It was their listing was like, they categorized it differently as they were doing it. It wasn't just hourly work. It was like non-recurring, CARES Act preparation stuff. They were very,
Nice.
very easily able to back it out, and they backed it out of their own financials before they even listed anyone, which generated a ton of goodwill in the
Yep.
buyers before they even talked to them, because they saw that
Yep.
they work. On the other end, the one that hit it, that is a huge red flag, because what I will tell all of my buyers is the most important thing is to make sure that your seller is honest,
Yep.
because there's an informational advantage that cannot be overcome before closing. You can only know as a buyer what the seller is willing to tell you. And
Yep.
so if they're dishonest, you're going to have imperfect information. And there's no way to verify or validate it. So that, kills the deal, versus it was not even a hiccup. It made the deal more attractive on the other
Yep.
side.
That's really interesting, Sarah. Thank you for sharing those cases. I'm sure with this case scenario that you shared, it provides our listeners with a vivid picture of what to expect and how to prepare for the various situations, when buying or selling. Now, as we start to wrap up our conversation, let's talk about what happens after the deal closes, after the deal is closed, what is the immediate next steps for the both parties?
I know. I always try to follow up because I don't always hear. um, Usually, I'm furiously responding to text messages from bankers and the client, and emails and phone calls last second to get all the DocuSign signed, and the little thing changed and then signed. In a perfect world, it's not like that, and it's very anticlimactic. So I have about 30% of my deals I've got dialed in enough that on the day of closing, everyone's like, "Is that it?" And that's actually great. That's a huge
Yeah,
accomplishment, because absent a lot of really great systems, it feels like a complete, oh gosh, we got to do everything. I'm
yeah,
ready
we got to do this.
right
Yeah,
now.
yeah.
Hopefully it's anticlimactic on your closing day. And, maybe that's a Friday, and then you're meeting with if you're the buyer, you're meeting with the seller, you're meeting with the employees. My recommendation for buyers is the first time you meet with the employees to give them a written offer letter, because it's a very, everyone wants to hire people right now. So you don't want to allow even the slightest moment of an employee feeling insecure in their position. Because if they get on Indeed,
Absolutely.
they will perhaps realize they're underpaid. They will probably
Yep.
find a different job, and that will cripple you. So it's, hi, my name is Sarah. Here's an offer letter. And it's written because people's auditory comprehension when their livelihood is on the line is terrible. We all hear wah wah
Yeah.
wah. You want them to be able to take it home and read it with their family over and over again
Yep.
and go, I am fine, I am fine, I am fine. So, maybe you've passed out those offer letters, and a lot of people like to, the day after closing, the sellers will tell all the employees, everybody goes back to their desk for like 30 minutes, and then the buyer comes in, introduces himself, hands out the offer letters, and takes everyone to lunch. That's kind of like
Hmm.
a nice thing
Interesting.
I see over and over again.
Yep.
And
Yep.
start notifying your clients. So, which might be different depending on if you're a CPA or not, how you have to phrase that. And, if you want to make it seem more of a merger growth thing, then that's
Yeah.
gonna, you're gonna have a lot of joint calls and joint lunches and coffees with big clients with the buyer and
Yep.
seller, if that's the case. And then the first tax season after closing, you really want your seller around to help you
Yep.
as you go.
Absolutely, absolutely. Because the seller knows, I mean, like you mentioned, they probably have insight about, some particular client that, this is how it happened and what's not. So yeah, very interesting, And I guess, between all this, I clearly see that, the role of ongoing consultancy is a must here, And I guess your role has been very much phenomenal in that, So what, post-sale consultancy and relationship management, I think is very critical here. But in your own words, I want to know more about it. How much important it is. Am I understanding this right? Or is this just a purely white collar, straightforward deal?
Is the question how important is post-closing consultancy from like a third-party consultant or from the
Yep.
seller? Okay,
Yeah. Yeah. From a seller.
from the seller.
Yeah.
Okay. Yeah, it's very, well, I mean, if you're running your business and you have a tax manager and you're on the golf course or you're on a sailboat, then, it kind of runs on its own. But I think
Mhm.
most of us, like me, run a business where if somebody else were to step in our shoes, there would be a lot of questions. And, maybe it's just, oh, we always get a retainer from this client, but this client, we never do. And it would be a very off-putting to change that all of a sudden. Just that kind of thing that is very, very important. So when you're selling the goodwill from a legal perspective, when you're selling a professional services company like this, you do a purchase price allocation, and a great deal of the money is going towards the goodwill of the company.
Mhm.
And
Mhm.
if you're buying goodwill, then the courts and the IRS have determined that there's some amount of transitional services embedded in that
Yep.
is necessary to transfer it.
Yep.
So I think it's important to iron out what that is and say, maybe it's, 20 hours a week for the first 6 weeks, 5 hours for the, 6 weeks after that, and just general availability for the remainder of the first year. And that's
Yep.
the general thought is after the first year, there's not a lot that people agree to on the front end because SBA rules right now don't allow for the seller to continue working for after the first 12 months after closing. So people typically just identify how involved they want the seller to be in the first 365 days.
Interesting. That's very interesting. I didn't, I mean, it's interesting you brought that out that SBA does not allow it beyond an year. And I guess it's healthy. It's a healthy timeline, right? That,
Yeah.
the emotional journey for the seller is also you're able to make a good exit while
Yeah.
maintaining your employees and everything, and the buyer is also happy.
Well, and I don't want to say that that's all deals, right? Because there really is a lid for every pot. So if you have just the regular small business owner, retiring owner who's selling an SBA financing, you're going to have that 1 year thing. A ton of people will in that year and say, this is going great. I let's re-up for 5 years. And the bank, doesn't seem to be involved at that point. That happens later. And I'm not there either.
Yeah.
But there's other deals. There's the big firms that come in and scoop up small firms. They will say,
Mm-hmm.
like, we're mandating that you work for 10 more years and we're not going to pay you the purchase price till the end of the 10th year.
Whoa.
And that's a thing that you can do if you're in your 50s and you've got no other succession planning type of interest or avenue locked down. And then there's private equity. Private equity will come in and they want you, like they need you to continue working for 5 years because they don't have a manager who can do what you do. So they're different buyers. I don't want you to think you need to wait until you only have a year, until you're comfortable hanging it up a year from now to
Yeah.
list your practice. You need to have a plan.
Yep.
So, there's other buyers with different timeframes.
Well, Sarah, I don't know what to say, but this has been incredibly enlightening. Okay. Thank you for sharing your wealth and knowledge with us. Any final thoughts or advice for those contemplating buying or selling an accounting practice?
No, I mean, check out dealacademy.org. And, my name is Sarah Sharp. I'm to date at Clockit at this moment in time, the only lawyer I know of who is focusing on this. And, I just love talking about it. So thank you so much for having me on. I really appreciate it, Saul.
Absolutely fantastic. Thank you so much, Sarah. To our listeners, thank you all for tuning in, and don't forget to join us next time for on your favorite podcast for more insightful discussions. Until then, keep navigating your professional journey wisely. Cheers.
Access latest and trending CPE courses with my CPE's Unlimited Access subscription. Subscribe now.